Hi guys, hope you're having a great day. So in today's video I just want to tell you guys about the 5 steps to trading the volatility index market consistently. Okay, so trading consistently, as you know, is not an easy thing. Okay, although a lot of traders out there, I think that trading is just about placing a trade and having a big bet. Okay, so when I mean trading consistently, I mean, winning again and again, month after month. Okay, so if you can do that, we say you're a consistently profitable trader. It's not about depositing 10, 20, $50 and taking it to $1,000. Doing it once in a while and blowing out the next day. Okay, it's not about doing it in a day and then the next day you're out of the market. You're out of the game. Okay, so it's about creating another stream of income for yourself and making money month after month and for as long as you want. Okay, so I have 3 steps right here. Number one, you have to understand trading from a probabilistic perspective, as every successful trader knows that trading is a game of probability. There's no way you can know on a trade by trade basis, right? When you place a trade in the market, there's no way you can know if that trade will go the way you want or not. Okay, it's always a probability. So let's say you place a trade to buy the volatility 75 index market with your strategy. You are never 100% sure of whether this will go your way. There's always the probability is always there that it's going to go against you. Okay, so that is how you have to think. You have to know that on a trade by trade basis, you can be right or wrong. So once you understand that, it's going to help you manage your expectation. Okay, most traders, once they enter, they expect to be right because maybe they've put in some indicators on their charts, or some some lines. They've drawn some lines and they expect that this line is going to push the market their way. Okay, but they enter and they find out that it doesn't go the way they want, and they get pissed and change the strategy. So if you want to become a successful trader, you have to understand that trading is a game of probability. Okay, so when you're trading, instead of looking at it as placing one trade and waiting for that trade to win, you have to look at it as a sample. You have to look at a sample of trades before you now determine whether your strategy is working or not. Okay, so a sample of say 50 trades. So after placing 50 trades, you check if you had more winners than losers. Okay, so let's say you placed 50 trade and you were risking 1-to-1 on each trade. Okay, and say 30 of them went well, whereas 20 were losers. This means that this is a profitable strategy. Okay, but if you are trading 1-to-1 and you placed 50 trades, and out of these 50, let's say 40 were losers. Were losers. Okay, this means that you're trading a losing strategy. Okay, and you have to change it. So having 1 or 2 losses doesn't mean that your strategy is not working. Okay, so you have to understand trading from this perspective. If not, you are never ever going to master trading. You are never ever going to become profitable in trading, no matter what you do, no matter the type of strategy that you use. Okay, if you had a winning strategy out there, if you are one of the people who have been looking for a strategy that will have 100% wins, I'm sure you are still looking for that strategy right now, but because it doesn't exist, okay, you never ever find that strategy. And if you keep on looking for it, you never find it, and you always be in that cycle. So you have to understand trading. You have to understand that no matter what you do, you always have losses. Just think about it. If you had 100% wins all the time, do you think you'll be richer than any other any other billionaires out there? If that was how trading was. Okay, so it's a game of probability. Okay, you when you place one trade, you never know what will happen. But after placing, say, 50 trades, what you discover is that you have more wins than losses. Okay, so and that comes from this second part that I mentioned here, creating a strategy that has a positive expectancy. That is the second step right there. Okay, after understanding that trading is a game of probability, then you have to create a strategy that has positive expectancy. And what this means is that after trading, okay, your strategy must win more than it loses. Okay, once you have a strategy that wins more than it loses, then it's a great strategy. Okay, so number one, that strategy must be in line with your personality. It must be a strategy that resonates with you. Okay, so you have to the strategy has to kind of make sense to you. If it doesn't make sense, then it's not going to work. Okay, if it doesn't make sense to you, then you are not going to apply. You are not going to use the strategy. So number one, it has to make sense to you. Okay. Number two, the strategy has to work. Okay, meaning it will have more wins than losses. Okay. Then number three, once these two, once you understand that the strategy has positive expectancy, or an easier way to check this, okay, is through backtesting. Okay, you have to backtest the strategy, or if you prefer trading, then you have to use demo account to trade this strategy, but that will take you more time. If you trade demo, you have to trade for about 3 months. Okay, so you have to spend about 3 months on demo before you now go live. Okay, but if you backtest, probably take you like 2 weeks, a week. In fact, a week is okay. If you backtest properly. Okay, so in this I'm going to show you guys a way to backtest the market in this video. Okay, so I'll go to my chart right now. As you can see, I have the volatility 75 index market. This is my entry chart. Okay, let's say you wanted to backtest, depending on whatever strategy you are using. But in this strategy, it makes use of 2 time frames: the entry time frame, the setup chart, which is the H1 right here, then the 5-minute chart. Okay, so whenever I find a setup here, I enter here. That is simply what it means. So let's say I find a setup here to buy. Wherever I find a setup, let's say here. Okay, let me put a vertical line there. Then you have to go to the Excel spreadsheet. Your Excel spreadsheet is what I have here, and you backtest that strategy. Right now I'm doing a little bit of a backtest because the strategy I'm currently using, I use trailing stops. Okay, I use trading stops. So I want to convert it to a set and forget strategy. Okay, I wanted to convert it to a set and forget strategy, whereby you just place a trade, put your stop loss, then your target, and let the trade run. Okay, but to do that, I have to backtest first before going to apply it. Okay, so this is what I'm doing right now, and I want to show you guys how to backtest. So what you do, once you find a setup like this, draw a vertical line at the point where you found the entry. Let's say this is the entry, this is the stop loss, and these are your targets. Okay, let's say this is first target, second target there, and this is the third target. Okay, so what I did, you come to this side and put in the entry date. For this particular one, the entry date will be what, 10th of I think September 2021. 2020, 2021. Okay, so you just put the date right there at the Excel spreadsheet. Okay, here's the Excel spreadsheet. So you put the date here, then the time, then so in case something happens, you can go back to where you stopped. Okay, so you don't get that's why you put this date. Then the time is so you can come back and check if this thing falls in line with the time when you awake. Okay, so later on you can work with these times here in order to know when it's best to be trading. Okay, then the stop loss, put your stop loss there. Then TP1, TP1, TP2. This actually happens after the trade has played out. So for this particular trade, you will see that TP1 got hit, TP2 got hit, and TP3 got hit. So in that case, I'll just come to this place and pull 0, meaning that stop loss was not hit. If it was hit, you will have placed -1 there. Okay, so TP1 was hit, TP2 was hit, and TP3 was hit. So you just put 1, 2, 3. Okay, simply. So this is the entry time frame. This is the time frame where you entered. Okay, M5. Okay, then this is the strategy. I'm using it's the same strategy, but there are three different scenarios. Okay, so there's trend following, counter trend trading, and there's range trading. Okay, I'm applying the same strategy, but different scenarios. So I put in these three different scenarios, then you add a little bit of comment. Okay, so at the end of all this, you now determine what's best for you. Okay, so you can come and say, okay, how many times did TP3 got hit? Okay, you come here and you just work with the numbers. So which one do you prefer? You can see that TP3 on this my short back test, you see that TP3 got hit about 1, 2, 3, 4 times. Okay, out of 12 trades. Okay, TP3 got hit 4 times. Okay, whereas TP2 got hit 1, 2, 3, 4, 5, 6. Out of this is not 12 trades. Sorry, it's let me go to the numbers. Okay, so we have 8 trades in total. Okay, so TP3 got hit 4 times, so 50% win rate for TP3. For TP2, we have 6 trades. 1, 2, 3, 4, 5, 6. So 6 trades were profitable for TP2, whereas 2 trades were losers. Okay, so do you prefer taking this, using this scenario or this one? Okay, so do you prefer taking less wins and as in little wins but not much losses? Okay, so what I mean, only 2 losses. Okay, but I'm only targeting 2. Okay, I'm only targeting 2 times my risk. You prefer that than taking more losses and so for this one we had only 1 loss. Okay, because I was targeting 1. Okay, so for some people they will prefer this, because so if you are someone who doesn't like taking losses, you might take this. Okay, if you are someone who likes who can take loss but likes more wins, then you can take 3 times your risk. Then here you add a little bit of comment. Okay, so at the end of the day, I'll do my analysis, how many wins, how many losses, and then I will select one of these and use it to trade in the future. Okay, that is as simple as it is. But not many traders will do that. Okay, because they are looking for a strategy that they will place a trade and take $10 to $1 million. Okay, which never happens. Okay, they always come back and blow the account, and they repeat that all day long. So you have to do the right thing. If not, you get in trouble trying to trade the forex market. Okay, so that is the second step right there. So the third step, the third step is that you must always apply money management. Okay, money management is there are 3 ties to trading successfully. You have number 1 is trading psychology. Number 2 is strategy. Then the third tier is your strategy. Okay. Then the third one is the money management. Okay, so psychology is about, it takes psychology, trading psychology constitutes about 60% of your trades. Okay, then strategy 20%. Sorry, yes. Um, okay, psychology about 60%. I just know strategy is about 10%. Then risk management 30%. Okay, so you must manage your risk every time you place a trade. So when you place a trade, you are not trying to gamble. Okay, so what happens is when you are trading, you never know how the wins or losses will play out. Okay, so let's say you place 10 trades, you never know how the wins and losses will distribute. Okay, and let's say you have 70% win rate, you don't know. So seven of the 10 will be profitable, but you never know how the trades will play out. So you might have one. You might have it like this. Let's say you had the first one was a win, second one a win, third one a win. Then the fourth one might be loser. The other ones becomes wins. Okay, like that. You never know how they will come. So that is why you have to manage your risk so that you don't get you don't die on a losing streak. Okay, so that you don't die on a losing streak. Most traders they come to the market and they start risking like 20% of their trades. Okay, so if you are risking 20% and you lose 3 trades in a row, what will happen is, after losing 3 trades you lose 60%. Okay, and then you have to make it back. Okay, so let's say you had $100 on your account. Now you are down to $40, and to make back this $40 now, you have to make back more than 100% of the account again. So you have to apply risk management. Personally, I'll advise you never to risk more than 5% of your account anytime you place a trade. Okay, but it all depends on your strategy. It depends on your strategy. So never risk more than 5% whenever you are placing a trade. Okay, if you want to go more conservative, risk no more than 3%. Okay, and if you are managing money for people, never ever risk more than 1%. Okay, because that time that is when your psychology will play with you like crazy. Okay, so never risk more than 1% when you trade for people. But for yourself, okay, 3% fine. Okay, always use a trade plan. So whenever you're trading, you need a trade plan. Okay, you need to know when you want to trade. Okay, how many hours are you going to be trading? Don't come to the market and stare at the screen all day long. Okay, maybe you just woke up in the middle of the night and you start trading. That is not good. Okay, you have to create a trade plan. How long, when are you going to be trading? What strategy are you going to be using? So you might come in and say, okay, I'm going to be a swing trader for this week. I don't want to check the market based on your schedule throughout the week. So what you do, at the beginning of the week, you have to create a trade plan and say, okay, I'll watch the market from Monday through Friday, okay, or from Monday through Saturday, whatever, okay. Then you create the times when you are going to be watching the market. Let's say from 8 a.m. till whatever, 12 p.m., 2 p.m., okay, or if you want, you can say 6 p.m. But you have to create that plan, okay, and don't just come to the market and start trading whatever you want, whenever you want. Just wake up, go to somewhere, you go and play game or watch TV and come back, and you are going to lose all your money doing having that kind of behavior. Especially if you're a day trader. Okay, if you're a day trader, you have to sit down on the screen and trade. Okay, once you're done, you close your chart and wait till the next day again to come back and trade again. So that is it. Always use a trade plan. If you're a day trader, you have to create these trade plans daily. If you're a day trader, you have to create these trade plans daily. So you open your chart, do your analysis, and you say, okay, I will trade this trade. I'll trade this. I'll watch these charts from 8 a.m. till let's say 4 p.m. Okay, then after that 4 p.m. you close your chart and go and do something else. Okay, follow the plan that you created. Doing that, you become profitable. Then that plan, in that plan also, you include how many trades you have to place. Okay, so for the day, you can say, okay, I'm going to trade only 3 trades today. Okay, 3 trades, and once you place these 3 trades, you close your chart, go and do something else. Okay, so either you see 3 trades, 3 setups, or if you don't see anything, so you go and do another thing at the end of the time. Okay, so keep a positive mindset. It depends on how you, different people have different ways of doing this. Okay, you have to find ways to keep your mindset positive, whether through um doing exercise, a lot of things you can do in this part. Okay, to keep your mind positive. That's very, very important. Okay, because trading is a mind game. When you come to the market, it can really, when you come to the market with a negative mindset, it's going to affect your trading. Okay, it's going to block your perception of the market. Okay, so instead of seeing good setup, you might start seeing negative setups. Just based on your mindset at that time. So you have to keep your mind positive no matter what you do as a trader. So that is it. If you want to become consistent in trading, these are the 5 steps. If you follow these steps, you are going to make money guaranteed consistently for as long as you want. Okay, okay. So that is it. So do have a great one. I see you again in another video.